Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, R&D Tax Credits, Food, Beverage, and Agribusiness Companies. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only one sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to introduce today's presenters, Liddy, Steele, and Josh Harbin, both senior managers here at Moss Adams. Their bios and contact information are located in your webcast console if you would like more information. And now I would like to turn the floor over to Josh to get the presentation started.
All right, thank you, Amy. Welcome, everyone. Thank you for joining us today to discuss research and development tax credits for food, beverage, and agribusiness companies. As mentioned, we encourage you to submit questions throughout the presentation. Time permitting, we'll answer those questions as they arise or at the end of the session. Our agenda today starts with a high-level overview of the R&D tax credit. We will then discuss what qualified research is in this context, what expenses can be included, specifically focusing on the food, beverage, and agribusiness companies. And then we'll finish with documentation requirements and recent developments. So starting with an overview of the R&D tax credit and its long history. The United States has a long history of incentivizing taxpayers to invest in resources in research and development. In 1954, Congress enacted Internal Revenue Code Section 174, giving taxpayers the ability to deduct research expenses in the year incurred. But by 1981, concerned that U.S. investments in R&D were declining, Congress added the Section 41 R&D tax credit, which is our primary topic of discussion for today's presentation. The R&D tax credit was extended several times after 1981 until it became a permanent tax credit with the passage of the PATH Act in 2015. More recently, while the Tax Cuts and Jobs Act of 2017 didn't directly change the R&D tax credit, it did modify Section 174 for years beginning after December 31st, 2021, such that the expenditures are required to be amortized rather than immediately deducted. And we'll get more into that a little bit later in the presentation. So what is the R&D credit and why should we care about it? The R&D tax credit is a general business credit and it offers a dollar-for-dollar reduction of regular tax. If it's unused, the credit may be carried back 1 year or carried forward for up to 20 years. There's no limitation or cap on the amount of the credit that can be claimed each year, but utilization will depend upon each taxpayer's circumstances. Lastly, the R&D credit is an incremental credit, meaning it's determined from the incremental research and qualified research expenses in the current year compared to a base amount. However, it is important to note that even taxpayers with flat or decreased spend in R&D may still generate credits. So how is the R&D tax credit calculated? In its simplest form, the R&D tax credit depends upon the amount of qualified research expenses in the current year, also known as QREs, less a base amount to determine the incremental QREs. Those incremental QREs are then multiplied by credit rate to determine what that gross credit amount is. And while the QREs are consistently determined, the base amount and credit rate depend upon the method used to calculate the credit, either the regular credit method or the alternative simplified method. Under the regular credit method, the credit rate is 20%, and the base amount is dependent on the taxpayer's prior 4-year gross receipts and a fixed base percentage calculation, which varies based on each taxpayer's facts and circumstances. Under the alternative simplified credit method, the credit rate is 14%, and the base amount is 50% of the average prior 3-year QREs. Each of these two methods have several nuances in how the amounts are determined, but that's beyond the scope of today's discussion. In most cases, taxpayers will calculate credits under both methods to determine on an annual basis which is more advantageous. All right, jumping into our first polling question. What is your level of experience with R&D tax credits? A, I'm an expert. B, proficient. I've had experience with an R&D tax credit analysis. C, beginner. I've heard about it before, but don't know much about it. Or D, this is my first time learning about it. And as a reminder, if you'd like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And while you guys are responding to the question, I'm going to go ahead and pull a question from our Q&A. It's around, does the R&D tax credit only apply to federal? The answer to that is no. There are actually approximately 39 states that offer R&D tax credits, and it really depends upon each state of what the rules and regulations are. Every state has their own ability to enact those rules, but generally they do align with the federal concepts that we'll be talking about today. All right, we'll just give it another moment here. All right, and moving on to the results. Looks like over half of the people here are beginners, which is great. There's a lot of great content we'll get into today to help you out. And if you're one of the few that is an expert in R&D, hopefully this is a good refresher, or hopefully you'll learn something new. And with that, I'm going to hand it over to Liddy, and she will take us through what qualified research is.
Thanks, Josh. So, referencing back to some of the history that Josh shared about the R&D tax credit, part of that history was sort of the legislative intent of this credit, and it was to stimulate innovation and development, with the idea being that that creates stronger economy. As you can imagine, when it came time to drafting the revenue code language regarding the credit, trying to encapsulate what is R&D is quite a challenge because it can vary so broadly across industry, across taxpayer, even year by year. So the definition of what is qualified research for purposes of the credit is intentionally very broad, so as to capture as many of those possibilities as it can. And because of that, there's also quite a bit of a subjective element to it. And that's where we're going to give you some examples of qualified research as it applies to food, beverage, and agribusiness, and how we've applied this broad 4-part test to assist our clients who are claiming credits. So the 4-part test is, at the highest level, the elements are: is it a qualified purpose? Does it eliminate a technical uncertainty? Does it involve a process of experimentation? And is it technological in nature? So we're going to dive a little bit further into each of those elements of the 4-part test. So that first element, qualified purpose. Is this development of a new or improved business component? And when we say business component, you can read their project. The business component is just sort of a IRS-specific language. So that project can be product, process, computer software, technique, formula, invention. Really, is it new or improved to you? And specifically, I want to emphasize, is it new or improved to you, the taxpayer, the company, because it does not need to be wholly new or an improvement upon existing technology on a state, national, or global scale, only to the taxpayer. So getting into some of the elements of, what does that mean as far as food, beverage, and agribusiness? This can be research that relates to style, that relates to taste, but other elements that are more style, cosmetic, aesthetically related, those would not meet this criteria. So for food, beverage, and agribusiness, taste refers to the sensory elements of taste. So moving on to the second criteria, elimination of uncertainty. So technical languages is the activity intended to discover information that would eliminate uncertainty concerning the development or improvement of the business component. How I like to frame that is, was there uncertainty as to how you're going to achieve your project objectives, either at the outset of the project, or perhaps you encountered an issue or a roadblock once you started? You thought that things were going to move smoothly, but once you really got into the project, you discovered that no, that initial design or concept that you were working from was in fact not going to get you the end results that you're hoping to achieve. So that would be a great indicator that you have met that technical uncertainty requirement. So there has been some recent case law around this question of what is uncertainty, and it really is based upon whether the information available to the taxpayer allowed them to establish that their design, their method, their process would work at the start of the project or through the course of the project. So in some cases where maybe in software development we see that they're working from sort of open source code to assemble a software product, that technical uncertainty requirement may not necessarily be met because that uncertainty threshold isn't quite there when you're working from established elements or components of a design. However, there is some software that we see in food, beverage, and agribusiness, though less frequently. Therefore, again, coming back to that kind of base concept of when you encounter technical uncertainty is when you're uncertain as to how to achieve your project objective at the start of the project, or you encounter issues during the course of the project, and that's uncertainty as to design, method, or process to achieve your objectives. So moving on to the third criteria, process of experimentation. This has become a real focus under exam lately due to some recent case law, and there are some interpretations that process of experimentation can only be that is performed in a scientific laboratory sense. Think, white lab coats, safety goggles, beakers. But in fact, what it means is that you are taking a systematic approach to resolve that technical uncertainty. So some examples of a process of experimentation that would demonstrate that systematic approach are modeling, simulation, systematic trial and error. So as long as you are attempting an element of the design, evaluating it, testing it, taking the results of that testing and improving upon that design, as long as it's incorporated back into your development process, that's demonstrating that systematic process of experimentation. So moving on to the fourth criteria, is it technological in nature? This is usually the easiest to identify, actually, because it doesn't rely on principles of physical or biological sciences. So we've listed here multiple examples of physical or biological sciences as they relate to the food, beverage, and agribusiness industries. It's probably easier to describe what does not meet the technological in nature standard, and that's more when you're looking at the social sciences and more of the sales and marketing type activity, and less related to design, development, or process improvement work. So speaking of those things that are not eligible, these are those that we encounter most frequently with food, beverage, and agribusiness clients. One is, was the research and development done after commercial production begins? The implication here is that if you are in commercial production, then you've resolved that technical uncertainty, and therefore that window in which R&D is being conducted has closed. However, there are some exceptions where you kind of have to get to commercial production to really confirm your product design or your process design is actually going to work for you, because you are operating at a commercial production scale. And so there can be some overlap there into commercial production, so just keep that in mind. The other activity that is not eligible is routine data collection or routine ordinary testing. So where you might be doing some food safety testing on a regular basis as part of your regulatory requirements, but it's not actually relating back to either your product formula or your process design. That would not be an eligible activity. Similarly, market research, if we use a blue label on our container as opposed to a red label on our container, are we going to sell more products on the shelf? If it's clear packaging versus opaque packaging, so that market research is also not going to be eligible. Any research conducted outside the United States, where you might be working with contractors, or perhaps you have a subsidiary outside the United States, that would not be eligible. And then also research related to contracts with third parties. Again, there may be some exceptions here. What's truly critical is the language in that agreement with a third party. So that's something that you would want to be reviewing before including expenses, R&D expenses related to contracts with third party in a credit. R&D related to internal use software also has another level of criteria and review is required in addition to the 4-part test. We're talking about food, beverage, and agribusiness clients' internal use software is generally that's used for your general administrative functions, including finance management, HR, support services, which is not to say that any investment and development of those software programs that you're making is not eligible. It just needs to meet this additional 3-part test in addition to the original 4-part qualified research test. And that 3-part test is the software innovative? Does it involve economic risk? Are you having to invest substantially in it, either through paying contractors or dedication of your internal resources, your employees? And is it otherwise commercially available for use of taxpayers? So this is to say you can't go out and purchase, if you could go out and purchase a similar software product, then it is otherwise already commercially available to you, and therefore your investment in development of that software may not be eligible. However, if the product that you need just does not exist on the current market because you have specific criteria, perhaps it needs to be integrating with other legacy software systems that you have, then it could still be eligible. So common triggers for R&D, or I should say, things that we see in the food, beverage, agribusiness industries that generally trigger more research and development. on an annual basis might be market conditions and demand. We're seeing sort of shifts towards healthier food options. You see your organics, your gluten-frees. Those can be those market conditions and demands. Environmental, social, and governance initiatives. Big emphasis on responsible use of water, electricity. Those can be driving forces in improvements and innovations, either in the ingredients you might be using for your products or in your processes. The cost of those resources, lots of supply chain issues lately. You may have an ingredient supplier who just frankly is not available to you anymore, or in some cases they are, but it's more expensive. And then you might start looking at reevaluating the formula for your products, the ingredients in your products. And then the fourth, there are natural disasters or significant events. Again, particularly from that agribusiness side, droughts, wildfires, hurricanes, hail, severe, ice storms. We've sort of seen it all lately, and those can also all be major drivers towards innovation. So we already talked a little bit about some of these. Another big one, food safety. We've all seen sort of the crisis created, particularly with baby formula recently regarding issues with food safety. So that's a big focus right now in terms of process improvement and innovation, as well as automation, labor shortages, driving a lot of automation in the food, beverage, and agribusiness industries. Some more examples from agribusiness. Wine, beer, and spirits. Big one we've seen lately is wildfire smoke taint. Thankfully, not as much in the last few years as we did in 2020, but I feel like we all have that sense that it's going to be coming around again every few years, and we're just fingers crossed that we can get through the wildfire season without too much smoke damage. So for our polling question number 2, do you think your company might perform qualified research based off of what we've shared about the definition of what is qualified research? And while we are waiting for people to fill out the polling question, looking at our Q&A, there was a question of how does the credit work for pass-through entities? Similar to other tax attributes, the credit will flow through to the owners of a pass-through entity, and if the owner is also pass-through, it will continue to flow through. Essentially, it will flow through the pass-through entities until it gets to a taxpayer who will actually be paying tax. So if you are a individual owning a pass-through entity, let's say you own 50% of that entity, then generally you'd be receiving 50% of the credit, and that would be applied against your personal income tax related to the income from that entity. All right, we're at about 83% completion on the polling question. Doesn't look like that number is moving, so I think we'll move on, see the results. So 42% of you said maybe, but need to evaluate more. 30% said yes, and 27% said no. So that maybe need to evaluate more, I think that's a great place to be at, because as I said at the beginning, it is such a broad and intentionally vague definition that it's totally reasonable that you might have qualified research, you may not. I like to say that just about any company is probably doing qualified research. The question is really to what extent and how much you're spending on it, and therefore is it worthwhile to pursue and complete an R&D credit analysis to claim that benefit. So with that, I'll kick it back to Josh for qualified research expenses.
All right, thanks, Liddy. So now we're going to transition into the types of expenses we can include in our calculation if we determine we have qualified research. So what are qualified research expenses, or QREs again? QREs include amounts paid or incurred by the taxpayer during the taxable year and carrying on any trade or business from the following categories. So these 4 buckets are our primary QRE categories: wages, supplies, contract research, and computer lease and rental. And over the next few slides, we're going to discuss each of these in more detail and how it applies to food, beverage, and agribusiness companies. So starting with wage QREs. These include wages to employees for qualified services. And the IRS defines qualified services to include activities for directly engaging in R&D, such as the individuals performing hands-on research, as well as those that are directly supporting or directly supervising R&D. So direct support might include an individual cleaning equipment used in qualified research, or a machinist making a part for a prototype pilot model used in qualified research. On the other side, direct supervision might include someone who is immediately supervising the R&D, but not actually performing the hands-on experimentation. And if an employee has both qualified and non-qualified services, that's totally okay. We only include the wages allocated to the qualified services in the calculation itself. However, there is an extra benefit for those employees that meet what's called a substantially all requirement, meaning at least 80%. If an employee is substantially all, then at least 80% of their services are qualified services. We can include 100% of the employee's wages, not just the direct percentage. And then for purposes of the R&D credit, we are specifically looking at taxable wages when we talk about wage QREs in general. So this is typically Form W-2 Box 1 wages or earned income from self-employment partnerships, if you're, say, a partner in a business as opposed to a direct employee. So importantly for wage QREs, employees aren't required to have a specific job title or educational background to be considered eligible. You don't have to specifically be an engineer or scientist in your job title to be qualified. It all depends on the types of activities that are being performed by that individual. And this is especially important in food, beverage, and agribusiness companies where the job titles may span, across the board, across a broad spectrum of different job roles. On the food and beverage side, we regularly see, product developers or managers, those people who are coming up with new concepts for food products or beverage products. We do see food scientists, or chemists, microbiologists, et cetera. And then additionally on the, kind of the production side, we see process engineers, mechanical or equipment supervisors, those individuals who are working more so on the process of creating that product. True distinction there between the product development and the process development. We also have regular inclusion of lab managers or quality assurance as well. From an agribusiness perspective, it's very common to see a crop manager or a grower, some of the more general job roles such as farmer. Those individuals may be performing R&D. We also see a lot of agronomists or PCAs, pest control advisors. Those are also common. And again, on the equipment side, there could be equipment development requiring mechanical or equipment supervisors. And then from a wine, beer, and spirits perspective, we also regularly include winemakers, brewers, distillers. Again, the lab managers or quality assurance typically have some involvement, as well as, at least on the winery side, or the viticulture side, we see viticulturists, vineyard managers as well. And then lastly, not listed on here specifically, is the owners themselves. Oftentimes we see owners or founders or partners that don't have a specific job title, but are involved in the research and development activities. Those individuals are also potentially includable. So moving on from wage curies, our next category is supplies. Supply costs include tangible property other than land or depreciable property. Supplies must be used in the conduct of qualified research and often include items such as ingredients and raw materials, additives, chemicals, testing and lab supplies, yeast, enzymes, parts, agrochemicals, or other general supplies. The key here is that it's tangible property that's used in the R&D itself. In some cases, we do see depreciable property that is the result of R&D as eligible. This is often for the design and development of prototypes or pilot models or customized equipment. These items are typically found with new or upgraded production facilities in the food and beverage space, or harvesting or packaging equipment as well. So think of the large capital items that might take a lot of research and development to attempt to create. All right, moving on to the next category, contract research. So this third category, contract research, includes 65% of costs that are paid to any person other than an employee for qualified research. So essentially looking at those third-party services. And for contract research to qualify, there's a couple of key criteria we look to make sure that we retain that benefit. And the first one is that the taxpayer must have the right to the research results. It does not need to be exclusive rights. They just need to have a right to the research results conducted by that third party. And then secondly, the taxpayer has to bear the expense even if the research is not successful, meaning payment is not contingent on success of the research itself. The IRS views payment that's contingent on that as essentially buying a finished product. Some common examples for this group of companies is outside lab testing. That one's pretty common amongst all the different industries here today, food and beverage, agribusiness, as well as wine, beer, and spirits. General consultants or contractors, engineering firms that are helping with those production facilities or new equipment design, and then general staff augmentation as well. This could be laborers in the sense of agribusiness, or just temporary employees that are brought in for a specific purpose. All right, the next category is computer rental and lease. And this last category generally is the least applicable to food, beverage, and agribusiness. It's computer and rental lease amounts for the right to use computers primarily for developing software. Technology was obviously drastically different when this was written back in the 1980s, when people used to have to actually go and rent time on a computer in a physical location. But it's actually become more applicable again with the push to cloud computing services, such as Amazon Web Services, Google Cloud, Microsoft Azure, for a few examples. So to the extent within food, beverage, and agribusiness companies that you're developing software, for example, to automate your production facility, and you're using those types of cloud computing resources to do that development, this may be applicable. And so with each of those four categories, they get aggregated into the overall qualified research expenses and included in that R&D credit calculation that we discussed at the top of the presentation. Each of those four categories are aggregated and included. All right, so moving on to the next section here. We went in depth on qualified research and how it applies to the specific industries today, and qualified research expenses and what may be applicable. Now we want to briefly touch on documentation and what might be expected. So the R&D tax credit itself doesn't have a specific list of documents required to claim the credit. Rather, taxpayers have to retain records in a sufficiently usable form and detail to substantiate those expenditures to claim the credit. So general guidance is, documentation should substantiate the amounts, so the numbers behind the credit, provide a nexus between those amounts and the activities that are being conducted, and then also identify and demonstrate what the qualified nature is of those activities. So some of the common issues we see with documentation relate primarily to availability of people and records for base years. We didn't go too deep into base calculations, but in some cases you could be looking back all the way to the 1980s, which can be very daunting, and records may not be available. In some cases, you could be looking back just the prior 3 years, in which case it's a little bit easier to find those records. Other issues relate to documentation not being contemporaneous. Contemporaneous meaning just developed at the time of the R&D. And then lastly, not having project or time-keeping records. It's not required that the credit be based on project or time tracking data. To the extent that's available, it's definitely useful. But sometimes it is a little bit more difficult for a subject matter expert to recollect and understand what was going on in prior years. So time tracking data is often very useful if available. And the next slide here just kind of lists some common examples of documentation, both quantitative to support those amounts and qualitative to support the research being conducted. From a quantitative standpoint, common documentation includes payroll records, tax returns, general ledger detail, invoices, time tracking data. And then from a qualitative perspective, this is typically something that the development teams create as a normal part of their development process. Examples might include project proposals, presentations, emails, meeting notes. It could be a lab analysis, soil or plant tissue sampling, field notes, organoleptic testing notes, trial results, engineering designs, etc. So essentially anything that development team would have been keeping track of over time during the process. Ideally, there are different iterations of the documentation, design version 1 versus version 2 versus version 3. In some cases, we know that companies don't always keep all the revisions and they just keep the final product. But to the extent possible, we like to illustrate the journey that the development team went on with that documentation. So even those ideas that were scrapped or failed are always great areas of documentation for purposes of the R&D credit. All right, moving into polling question number 3. Does your company or client currently have a policy to retain records related to R&D projects? A, yes, everything, including the documentation for what didn't work. B, only related to the final product or design. Everything else is discarded. C, only the expense records. D, no, it's all kept in the heads of a few key people and embedded in general expenses. So we'll give it a few seconds here. We'll look at the questions. I think there was a question on state R&D credits again, or a follow-up question around federal and states claiming both of them. So yes, you can claim federal as well as whatever states are applicable. That's totally acceptable. So let's see, we've got a few more people we're waiting on. Give it just another second here. All right, we can go ahead to the results. All right, we got a good broad cross-section of answers here. I like that most people selected D, at least. It's all kept in the heads of a few key people. Those are often the hardest R&D projects to document, but definitely it's still doable. Our recommendation would be to get as much knowledge out of the heads of those few key people and attempt to get that documentation developed, at least in the form of informal notes. That's always helpful. And for those of you that are documenting everything, great, keep doing it. All right, I'm going to go ahead and pass it back over to Liddy to talk about some recent developments.
Thanks. So late last year, there was a Chief Counsel memorandum that was issued that specifically applied to research credit claims on amended returns for a refund. And if you are a taxpayer that is amending your return to claim an R&D credit, and that credit will result in a refund, there's now an additional documentation requirement that has to be submitted with the amended return. Prior to this, it was you would submit your 1120X and include the new Form 6765 to claim the research credit, and that was essentially it as far as the process went. But now, in addition to the 1120X or whatever income tax form you may be filing, you also have to provide some documentation to support your refund claim. So that documentation is identification of all of the business components to which the research claim relates. Remember that business components are essentially the projects to which the credit relates. The research activities performed for each business component. So this is where you would need to, write up sort of a description of what each project was and the activities that were performed by your employees, by your contractors. The individuals who performed each of those research activities need to be identified. A description of the information sought by each individual related to that project or business component. So sort of what was each individual's role in the project. And then the total qualified employee wages, supply expenses, and contract research expenses. For taxpayers who are claiming larger R&D credits, this is sort of information that hopefully you would already be assembling as part of an R&D credit analysis. And therefore you would already have that on hand, so this requirement may not be as onerous. However, for taxpayers that are claiming smaller research credits, this additional documentation burden, the resources required to assemble this information, or the expense incurred if you were to contract an R&D tax services provider to help you assemble this information, this could be a bit of a deterrent for you. So it's just something that we want to bring to your attention. And the takeaways from this are, it's not to say that you should not amend the return to claim a research credit, but you might be doing a cost-benefit analysis before doing so, just to make sure that the benefit received is going to outweigh the additional burden of assembling this documentation. If you can, however, try to get your research credit claims on the original returns so that you do not need to provide this additional documentation. For those of you that are partners, or the taxpayer is a partnership, and if you are not opting out of CAR, amending to claim a research credit in addition to this documentation requirement is also a whole nother beast in itself, because you would also need to submit an administrative adjustment request. That request may not necessarily be approved, but there would be additional documentation, calculation work required if you are a partnership that is also looking to amend. So also related to this, if you do not submit this information with your amended claim, then for the first year, there's an opportunity to correct that deficiency. And this is a one-year transition period starting January 10th, 2022. So this will run through January 10th, 2023 of next year, in which you have 45 days to correct your deficient claim, which is essentially 45 days to provide that required information. If you do not provide that information, then it is grounds for them to deny your application for a refund. So for IRC Section 174, in the Tax Cut and Jobs Act, there was a provision that changed the treatment of IRC Section 174. So this is the language regarding deductions for the research and experimental expenditures. And prior to this, or prior to December 31st, 2021, taxpayers had the option to immediately deduct research and experimental expenditures, which created a substantial double benefit where you have the immediate deduction of those expenses as well as the R&D credit related to those expenses in the same year. However, under the Tax Cut and Jobs Act, as of January 1st, 2022, taxpayers are now required to capitalize and amortize research and experimental expenditures. If they are U.S.-based expenditures, that amortization is over a 5-year period. If they are non-U.S. based, it is over a 15 period with half-year convention. So this is obviously a very significant change for taxpayers that are very heavy as far as their research and development expenses. This could have a significant impact because, as you can imagine, it could increase your taxable income for the year. So if you are a taxpayer with substantial research and development expenses, please start looking at those now, modeling and forecasting. If you have increased income, then that credit could be all that more beneficial to you in the current tax year. Or depending on your tax position, maybe there's an argument for reclassifying some expenses so they're no longer considered research and development. So when looking at your expenses, the definition of IRC 174 is cost in the experimental and laboratory sense. Please note that this includes R&D expenses that are not otherwise includable for the research credit. Things like patent expenses, some software development costs that are not eligible for the R&D credit are still would still be classified as IRC 174 expenses and therefore subject to amortization. And then I guess one last legislative update before we get to the final polling question on that is a repeal, or at least a delay, a pushback of this change has been included in pretty much every major legislative package in the last year. So far, either of those legislative packages, it was included in the Build Back Better plan, either did not pass or they passed, but only after any repeal or delay of this change to IRC 174 expenditure treatment was removed from the language. It is still being discussed. There is bipartisan support for that repeal or at least delay. It is, in active discussions for the next legislative session later this year, and trying to still get it through as part of budget reconciliation before year end. However, since we are already past the mid-year point, we just want everybody to be aware of this and start working with your tax return preparers for any sort of planning that you may have around changing classification of your research and development expenses, or utilizing things like the credit to try to mitigate any increased tax that may result from this change. So with that, we have our last polling question. Does your company or client currently have a policy to retain records related to their R&D projects? Did we get these mixed up? I think we might have already asked that polling question, but we will ask it again for the sake of everybody getting their CPE. So feel free to provide the same answer, or if you want to mix it up, provide a different answer this time. But please do answer so that everybody can get their CPE. And while everyone's filling that out, some Q&A questions. Does the Section 174 change also apply at the state level as well? The answer there is yes, it does. There are currently 23 states whose language automatically conforms to the IRC, including 174. So in those states, you will also be required to amortize research and development expenses. There are 19 states that do not conform to IRC. So you may be able to maintain your current treatment of R&D expenses as a fully deductible expense in the current year. If we're looking at the West Coast, Oregon currently conforms, so you may need to amortize research and development expenses in Oregon. California, Arizona, Idaho do not. All right, we're at 79%, having answered the poll. Is there anybody else out there that needs their CPE credit? Can we get that above 80%? I can stall and ask and answer one more QA question for anybody who might have gone to refresh their copy, because I know that we are getting towards the end of this hour. Another QA question. What happens to the credit if the company is sold? Depending on the nature of the sale of that company and whether it includes essentially the flow through of tax assets, either the acquiring company can utilize those credits if they flow through, or if it's a asset sale of the company, that's probably the easiest one to define, and therefore the company will terminate as of the end of the sale, or for whatever other reasons the tax attributes are not going to be flowing through in the sale, then the credit will not flow through to the acquiring company. It will be utilized by the pre-sale company or the owners of that company if it's a flow-through entity. And it is also, there's an opportunity there if it is a flow-through company for those owners to be able to utilize the R&D credit to offset capital gains tax, potentially related to the sale of the company. So for any companies who maybe were not previously in a taxable position and could not utilize an R&D credit, if you have a upcoming transaction or sale, now may be a time to reevaluate your R&D credit claims to offset that potential capital gains tax. Okay, we're up to 83%.
It looks like there's a follow-up to the pass-through question you might have answered earlier. Does the credit flow through to owners if we are a pass-through entity? And yes, the credit does flow through to the owners or shareholders of the pass-through entity. The owners can use the credit to offset tax attributable to the income from that same business that generated the credit.
It looks like we have another one related to amortization of 174 R&D expenses. Do we need to amortize R&D expenses even if we don't claim the R&D tax credit? And the answer there is yes, which is why if you are not currently claiming the R&D tax credit, but you do have expenses that would be classified as R&D under 174, now may be the time to look at taking advantage of the credit to offset some of that potential increased income tax liability. And then the question of how do we treat big equipment that we purchase for R&D work? The answer to that question will depend on the nature of that equipment. If this was custom-built equipment specific to you, the equipment itself might be eligible as an R&D project, and you could potentially include a significant portion of the cost for that equipment in an R&D credit. if it's otherwise equipment that is being purchased solely for use in R&D work, and I mean solely for, it cannot be used for any production activity, there is some language that may permit you to qualify at least the depreciable amount of that equipment as an R&D expense for the year. Okay. Another great question that we had, or Amy, do we have time for one more QA question? I know you had some wrap up.
Yeah, we can do one more.
Okay.
And then we'll close out.
Another great question that we had, and something that we see quite frequently with both entities, is what if the owner of the company is involved in R&D but doesn't draw a salary? So they're not drawing a W-2. Can their distributions, guaranteed payments still be included as an R&D expense? The answer to that question is yes, they may be. There is an additional analysis that may need to be conducted to show that their compensation in the form of guaranteed payments or distributions is reasonable, but you may be able to still include some of those as an R&D expense.
All right, I think we are going to start wrapping this up. Thank you, Liddy and Josh, for a great presentation today. And also thank you to our audience for being engaged and submitting your questions to help guide today's conversation. And feel free to reach out to our presenters if you have additional questions. Their contact information is in your console. And then we also have another webcast coming up next week, which is Set Your Agribusiness Transaction Up for Success. We did provide a link to the registration page in your console, so hopefully you can join us for that one as well. And then also, if you met all CPE requirements, your certificate is available to download now in the CPE progress window. And we will email out a copy within 3 weeks should you have difficulty downloading it now. And then finally, here's a link to an online survey for today's presentation. And thank you for joining our webcast. We hope you'll join us again next time. Take care, everyone.
Thank you.
Thank you.